Hi, everyone. So I've got with me here Richard Bergen. Richard Bergen is the managing director at a firm called Alvarez and Marsal, which is a highly specialized economic consultancy. I know that Richard has acted as an expert witness in cases involving credit cards, for example, and questions of market dominance around credit cards. He's also been in a case with Microsoft, but he can tell you more about that. The reason why I know Richard is that I sat next to him at business school, and I was extremely envious when he went on to do a PhD at Harvard Business School, which is a path that I might have liked to have followed. But we have amazing conversations when we get together, and he reached me earlier today, and there's a banking crisis going on, and I thought rather than just talk to Richard privately, we'd get the conversation online. And so we're recording this kind of ad hoc. And I have a bunch of questions for you, Richard. But before I get into the questions, why don't I let you say hello to the audience? So go ahead and say hello.
Well, it's great to meet you all. It's a real pleasure to be talking with Guy, who is one of the preeminent investors, at least in my experience.
It's extremely kind of you, Richard. And just that you know, if those of you who are watching this on the video, Richard's library is an awesome library. He's read every single one of those books, unlike my library, where I've read very few of them. And just over Richard's right shoulder, you have a photograph of him on his wedding day, getting married to his wife at the time, who's also a friend. So Richard, just to make sure before I dive into questions about the current banking crisis, I touched on some of the cases that you've been involved in the past. Can you either correct or fill out, based only on publicly available information, what I said, and explain better to the audience who you are?
Sure. So after my doctorate at Harvard Business School and my MBA, I now currently co-lead the economic practice here at Alvarez and Marsal in the US. And there I touch and assist clients with numerous issues, whether it's securities, large class actions, government regulatory interventions, as well as antitrust cases like the one Guy Spear just touched on. And through that, assisting clients around the world, I get a glimpse in what's been going on at the coalface of companies as they face these sort of these issues of trust and government reviews and regulatory concerns. And also I get to see what's been happening with the Federal Reserves, not just in the US, but around the world, as inflation has got their attention front and center. And now they're actually addressing it by raising their rate, the Fed funds rate, for example, and the stresses that is causing around the world.
Yeah, and so if I understand correctly, and we'll just have to erase this if it's not public, I understand that you're involved in both the resolution of Silicon Valley Bank and of FTX. And
that's right. Alvarez and Marsal, the firm that I work, are involved in those two matters. And because they're active, I will not be able to speak about FTX and its resolution, the bankruptcy courts, as well as Silicon Valley Bank, who we also are representing at this moment.
Yeah, so good to get that off the table. So my first question was going to be, can you tell the story of, can you explain to people what happened at Silicon Valley Bank? But I guess we can't go there. We're better off not going there.
I think I shouldn't be on the record. I think what's public is sort of well known now, which there was a mismatch between their depositors' funds and their investment marks. And so basically, as they continued to carry loss from their investments and they didn't mark to market, there was a loss of investor confidence. And as you would have read, a number of prominent individuals, venture capital firms, told their investment funds to pull their funds from Silicon Valley Bank. And then it was a classic run of the bank.
Yeah, and
loss
so
of confidence.
Yeah, and if they would have held those long-term bonds, which were trading at a loss to the purchase price, if they would have been able to hold them to maturity, there would have been no issues. but with the sudden loss in deposits, they were put in a position where they would have to sell those at a loss. If the whole bank would have had to have been liquidated today or at the time, then there wouldn't have potentially been enough funds available. But if we just go, so we were on the phone briefly about an hour ago. So that seems to be a problem with all the regional banks as well. There are many regional banks that have the same problem.
Certainly the small to medium-sized banks, unfortunately, have been caught in a similar issue. And so just a cursory review of a handful of those banks reveal they have similar issues. That is, they have a mismatch. And if they did mark to market their assets, if they held them to maturity, as you said, yes, they may have a small loss. But if they had to liquidate, then they would be insolvent, technically insolvent today. And that lack of confidence, there's been a very strong reaction from the Federal Reserve. So Jerome Powell, as you know, opened up an investing window and has permitted any bank, large or small, come and redeem those bonds at par. And that has led to a massive funding at the window. In fact, it's been unprecedented. It's been this high. In fact, it was higher than it was in the great financial crisis. So a massive amount of liquidity just flew back into those banks as they're trying to assure their investors and depositors that they are well capitalized.
Just to understand this, Richard, so if I'm a regional bank and I received an inflow of deposits, I went and bought 5-year government bonds at a 2% yield, and now those bonds are yielding closer to 4.5%. So there is a discount on those bonds, a mark-to-market discount of maybe 12 to 15% is what I would imagine. And now, because that federal discount window has been opened, I can take government bonds which are trading at, say, 85% or 90% of par, and I can take them and I can get par for them.
Correct. And you know what's fascinating to that exact question, Guy, is not only are the small and regional banks rushing to the Fed to get par, and the window's open for 1 year, but also foreign banks. So I believe the numbers are, the small regional banks may have gone to the window. You can look at this is all public. I believe the number is like $41 billion from the small and regional banking system, but international banks are over 60 billion.
So
so in other words, a whole bunch of participants in the market are going and taking, they certainly make themselves presenting those bonds that were at a discount because of the increase in rates.
I mean, that's basically free money. They're giving free money. I mean, you ought to have to take a loss on those bonds. I mean, I like that deal. Is
Great
there
deal. I was about to say, do you have any of those lying around? Then I'm a buyer. So right now, it is an incredible value opportunity. And it's quite amazing because, as you know, I just had mentioned, we've just been discussing, because of inflation, how the central banks of the world, including the ECB, Bank of England, of course, the Fed, the Canadian Bank, the Australian Central Bank, have all been raising rates. Yeah. So all the people who have these bonds are now being caught because of this rise of interest rates, or the Fed funds rate, or the Treasury yields, for example. So now the Fed's given the ability to basically wipe off that loss, which is quite phenomenal. Because if you remember, they were trying to tighten in face of inflation, and now they just pushed a whole bunch of liquidity back in the system, which is a little counterintuitive if you think about it.
Are there any banks that have been excluded? And can you recycle? So if I'm can I go and buy up other people's bonds at the appropriate discount rate and then put them to the Fed?
Well, it's funny you should say that, because there's more work to be done, of course, but it would make you wonder that there would be a tremendous opportunity if you happen to be a savvy investor, and you could look at the full risk of some of these banks that were exposed. And right now, all these banks are trading at a deep discount. You know, we can go through the numbers, but of course it's all public. Deutsche Bank is down 20%, 20.8% today. You know, the regional banking index, overall banks are down 20%, 21%. If you go into the regional bank index, it's down 27%. And finally go to Deutsche Bank, not Deutsche Bank, First Republic Bank, which is another one of those smaller commercial banks, and that's down almost 89, 90%. That was a few hours ago. It may have gone up again. So just imagine if you take that bank and take that debt to the window. The question is what else is going to. The real issue is investor confidence and trust around the bank. The deposits are getting drawn out of the bank and moved to, say, places where people believe they have more safety, like Bank of America.
So I mean, it's fascinating for me. So in my case, Richard, I watch with bemusement unless there's clear. I don't like acting in crises. I think that there's as high a likelihood, or more of a likelihood, that I'll make a dumb move during a crisis than a smart move, and so I kind of tend to just watch unless there's something very, very clearly. And during a time of crisis, a lot of rumors fly around, either positive or negative, and so. And there's perfectly fine to do absolutely nothing. But if what I understand you've just communicated to me, which, by the way, as a guy who's a reasonably close observer of things banking, it was not as clear to me as that. It seems to be a no-brainer that there is absolutely no issue with any of the regional banks, let alone the money center banks. And I tried to have a quick glance at Deutsche Bank's balance sheet to see if I could unveil sort of mark-to-market losses on bond portfolios, and this is just from their quarterly statements. And I don't even see that they hold that much of their asset, the asset side of their balance sheet in government securities. So they're not even exposed in that way at all. So
that's an excellent point. I mean, Deutsche Bank, as you know, one of the preeminent banks in the world, and right now it's fascinating to watch this lack of investor confidence in this very solid and well-capitalized bank, and we can touch on that for a moment. That right now the credit default swaps, which is an instrument where people are looking at insurance against their default, has risen sharply from the beginning of this month, March 9th, it was in the 80s, 86. Now it's over 200. I think it's currently 220 as we speak. So there's been this massive increase. Same thing happened with Credit Suisse. And what's curious is Deutsche Bank last year had a record profit, I think over $6 billion. Phenomenal year, right? Very good income for the bank. And that is in contrast to Credit Suisse that had a massive loss. Deutsche Bank also have got very good credit ratings. I mean, very strong capitalization. It's been very well regulated by the German regulators.
They've got 13%.
Yeah. And yet it's trading at a discount to book value at 30%. Below Barclays, below. And so I'm not a super expert in this sector of the world of investing, but it's curious. I know they did have, for example, they did create a bank to take all their bad loans and bad portfolios, and they put it into this separate special purpose bank. There may be some concerns there, but it's such a well-capitalized bank, it's hard to imagine why there is such a wide run-up on the perception of risk of this bank.
Yeah, I mean, just to attempt an answer at that, I don't know by what mechanism, but one of the news articles perhaps that you sent me, it's sort of like the investors are searching for the next point of weakness to test. I know that you can't ascribe a mind to the market, but and it's interesting to me that the fears go not to the worst capitalized bank, I don't know which one that would be, but it goes to the one in a sense with the worst reputation. And Deutsche Bank has had a string of, well, just probably a decade or two of bad years, and so it's the reputation that counts. But just to go to Credit Suisse for a second, I mean, we have current accounts at the fund management company with Credit Suisse, very small dollar amounts or absolute amounts of money that were potentially at risk as deposits. And I asked myself the question more than once over the last year, should we be banking with Credit Suisse? And I came to the conclusion that there was absolutely no risk to the deposits in the slightest, but it didn't stop in clients losing confidence. What's fascinating, and you realize we're talking right now on Friday, it's only 5 days ago that the Credit Suisse was sold to UBS. Seems like an eon ago, but they were offered 50 billion line of credit from the Swiss National Bank, which was I kind of like figured out this practically infinite amount of money. I mean, it was as if
they were never going to fail. I mean, that's what is fascinating to me. Ultimately, you're absolutely right. It's all about investor confidence. And then what was interesting, as you have probably read, where you live in a lot of your life in Switzerland, that the government regulators wanted to ensure the people of Switzerland that bank would not fail, and that UBS would be the white knight. I mean, very similar to JP Morgan and a bunch of banks coming to Silicon Valley Bank, or back in the day to Bear Stearns. And so they did not want to have a bankruptcy. They did not want that solution.
I mean, it was a shotgun marriage, is one way of putting it. But they could have, they could have. I mean, with the 50 billion backstop, maybe the story will come out. You would have imagined they could have just gone to Monday morning with a $50 billion backstop, but they weren't willing to do that. They forced a merger over the weekend, and maybe they have access to information that we don't have.
Well, that's guaranteed.
Pardon?
Yeah, the regulators. Yeah, the regulators have an immense amount of information that we will never.
There was no way that Credit Suisse was opening as a going concern on the Monday morning. In a certain sense, what many of the commentators in Switzerland are saying, what the hell was all that work that we were doing over the last decade over regulatory capital, if none of that seems to matter, because a bank with sufficient regulatory capital can still fail for a loss of investor confidence, basically.
Right, it's the counterparty risk. It's always comes down to that level. But as you know, if you follow these financial crises, which happen occasionally, every so often, quite a regular, that when you follow that area, there's always something different that causes the crisis. It's never the same. So when regulators then bring in a raft of protective measures, very, very well thought through, as they did after the great financial crisis, both in Europe, in the UK, around the world, in the US certainly. Those issues address specifically the root causes of the great financial crisis. And of course, the seeds of this crisis are a different part of the global financial system.
Yeah, it's strange though, because having enough capital should have taken care of it, really should have taken care of it.
Yes, it did, but the investor confidence, it didn't.
Right, and investor confidence is something that you can't regulate. And you can scream at the people who are selling Deutsche Bank shares until you're blue in the face that they don't have a capital issue. But I think that I don't know if accounts are leaving Deutsche Bank, if accounts are switching. And I think that what's also interesting to me is that if I understand in the American financial system that when people are pulling deposits from places like Silicon Valley Bank or other regional banks, they're tending to put them into the larger banks. I mean, they're not buying treasury bills directly. I don't even know if they're
moving. Right, correct. What's happening right now? Other banks are offering larger percentage returns if you invest. You move your account to a different regional bank, so you can go from 5% to 7%, and so they make it quite attractive. And so when there are runs because of concerns, rumors often, it literally is like a run of the bank. And so people pull their money, and then all of a sudden the bank really does face a crisis.
And there's this amazing phenomenon that now we don't see queues in the street. It's just an internet phenomenon, which is the first time this is new, how quickly confidence can be lost and how quickly people can switch accounts. It used to be that you'd have to actually show up at the bank and sign a bunch of documents. Now, if you decide to move your account, you can do it online. So you can have an absolute avalanche of account moves.
It's in the blink of an eye. So if you go back to say this is going to maybe mischaracterize it, but the early run of the bank videos, if you go to the classic Mary Poppins movie, and they have all of a sudden there's a rumor on the street, and also suddenly people lining up the tellers looking to withdraw their funds. Well, now in the blink of an eye, as you just mentioned, people can pick up their iPhone and just make the transaction happen.
So
And that's a concern.
just
So
to
it's
dive
really the
into
speed of transactions. But
yeah,
I think the big impact going back to small regional banks and the impact on business is that right now, commercial loans to small and large business are more or less frozen. 70% of all commercial loans come through small to mid banks. They have stopped lending.
so
And large banks have stopped lending. So basically the volume of money flowing out into Main Street, as some people call it, has basically been frozen.
so
And that's a massive problem.
I want to dive into that for a second. And just for those listeners who are interested, what we need to understand is that even if the Federal Reserve or a central bank wants to make sure that credit is available, they make credit available wholesale. And even if they make it available wholesale to the financial system, that doesn't mean that it gets to the people that it needs to get to. And imagine that you can produce all the food in the world, but you need to spoon feed it into 10 million babies. And unless you have the people at the front line spoon feeding the 10 million babies, it's just not going to get into their mouths, no matter how much food you produce. The central bank is this big food producer, and the regional banks are the ones who are spoon feeding it into the people who need it. But if the regional banks are being made whole on these mark-to-market losses, why have they stopped lending?
They're worried about credit risk. They have to assess now, they're concerned. So there's, as you know, during the last 2 years, a lot of businesses recapitalized, and they had very attractive funding terms. We're talking, the Fed fund rate was essentially zero, and that was the same around the world. And that was important because the great financial crisis, government stepped up and they really made sure that companies could have access to capital so they could remain in existence, right? So now we're in this place in the new world, and all those companies are still there. Well, that debt, whether they got it at 2%, 3%, 4%, well, now they need to recapitalize it. Now those firms, when they go back to get more debt, it's now coming in, if you follow it, anywhere from 5% to 9%, depending on your credit worthiness. So those banks now have to re-rate, say, are those firms able to afford that cost of capital increase? Because they've basically just doubled or tripled, depending on these firms.
And given that the banks now have, so the banks have been surviving on these extraordinarily low interest rates, they now, to get the same revenue on the top line, can make so far fewer loans they can afford to pick and choose in terms of credit worthiness. Do you think that if, Richard, in our dreams, you and I had been running, one of us had been at US Treasury and one of us had been at the Federal Reserve, do you think that we would have raised interest rates as fast? Because it's been kind of precipitous over the last 6 months. And I feel like it's caught people on the back foot.
Yeah.
And I mean, hindsight is always 2020. And I realize that you want to nip inflation in the bud. But I just imagine that with hindsight, maybe those rates went up too fast, not allowing people to adjust their expectations.
I think it's a matter of education. Because I think the Federal Reserve and Jerome Powell is certainly a student of inflation, and he's one of the best economists on this area. And he would say, and I think a lot of economists know, and it's been proven, that inflation ultimately is a monetary problem. There is too much liquidity that was pushed into the market, during the pandemic. And
sorry, I have to just interject and say, I think.
Yeah.
Too much liquidity.
The walls are awash with cash.
Didn't you know? I was walking down a nondescript street in Manhattan, and I bumped into Jerome Powell saying, "Here, would you like a stash of cash?" They were practically handing it out on street corners.
Oh, for sure. They wanted, businesses and the people, like everyone. There was no. So And that's why everyone still, to today, American consumers, I think also around the world, they've got so much liquidity, they're still spending, they're still confident. And that's why inflation is still a problem. It's not slowing down. And so raising the rates as sharply as they did, as Jerome Powell chose to do, or the Federal Reserve chose to do, and certainly the Bank of England, certainly the ECB have chosen to do, is the only move they've got. However, they could have signaled they were going to do it. Clear. When we met, if you remember, it was now 6 months ago in London, those signs were clear back then. Inflation was here. And Jerome Powell could have been signaling much, and I think they've been signaling now, he has been consistent really since February to the market, that they were going to increase rates sharply and hold them there for an extended period of time. What's interesting to me, maybe to you, is being the disconnect. If you go to the bond market today, it's much below where the Fed has shown and projected in the future in the dot plot.
Because so many, I mean, I think that I as a market participant, I try to live my life, you know, not sort of acting in prediction of some of these things, but the expectation, I think, in my mind, held in the back of my mind, was that the majority of inflation has come along because of the hike in energy and commodity prices, and that this will be a blip, and that once supply chain issues are worked out, and once these commodity prices have been equaled out, then inflation will come back down. And so the high interest rates was a temporary measure that would be removed within 18 months. That was the kind of assumption, implicit assumption, that I think many people made, including—
it's a very hopeful assumption, because you're absolutely correct. One of the elements of the inflation that we were experiencing, and our experience, was, of course, in some way linked to the war and Russia's invasion of Ukraine, which of course is the big source of grains for Europe, but also energy, and other actually essential materials. And so that was certainly a cause that added to the inflation. But if you go back to an earlier comment that Jerome Powell believes in and has stated, there was just too much liquidity. There was too much money pushed into the pockets of companies and people, and they're out spending once the pandemic ended, and they spend it on, you know, on many things. And so now you can see that in many areas, but for example, the real area is labor. To look at unemployment, which is still at an almost near record low, and there's just not enough people to get the job done, you know, to keep restaurants and bars and hotels, to have factories working, you know, for businesses. Labor is a real problem at the moment. And in essence, that's pushing up the cost. It's, you know, as you know, England just this week had a record inflation, continued to ramp up in food, restaurants, things like that. And so the whole inflation issues, yes, it would be terrific if it would go away in just 18 months. And there were some predictions from some very famous economists, I believe Goldman Sachs combined, was totally in that camp. And they believed inflation was going to, they've reached the peak, inflation was beaten, it was coming down. Unfortunately, we looked at the core drivers of inflation, the ones the Fed are most concerned with. They have shown persistence. And because of that, the Fed will keep raising rates, or at least hold them high longer. And it's that discomfort that's impacting the banks. Sorry.
Is there, I'm just trying to, I know that the central banks have a lot of influence over short-term rates, very little influence over long-term rates. And I know that it's not, there are various levers that they could have pulled to reduce liquidity. I'm not aware of what levers they pulled or what they are pulling.
Oh, they were draining for this year. They've taken out a massive amount of liquidity around the world, that's why it's so funny when they open the Fed funds window, they completely reverse the impact.
But they may be, you know, of making liquidity available short term, but still raising interest rates medium term by.
They're staying the course. I think also you can imagine the Federal Reserve and all the central banks, they now must show that they are focused on getting inflation down, because inflation really is a pernicious problem for businesses and consumers. It's a terrible thing to live in a country with high inflation.
I mean, 3 or 4% inflation, not terrible,
Oh, 3 or 4 should be fine. But I think in England, I believe it was 20%, for example, for food.
Yeah. And but
still,
the strange thing is that one of the reasons why I have liked money center banks is that in an inflationary environment, this is actually really good for them. They have fantastic, their net income margins go up. Many of these banks, especially the larger money center banks, have enormous deposit bases. And as we see in a crisis, people tend to, those deposit bases have increased.
yeah.
Bank of America has about 10% of the total US deposits. I read that in the last couple of months, those have increased by about 15 billion. And I'd have to review to check by what percentage that is. But most of those are not interest-bearing deposits. So you can turn around and reinvest them at far higher interest rates, which means that your profitability goes through the roof. So the money center banks actually, are actually in a fantastic place to be in this inflationary environment.
Yeah,
even though people are scared stiff.
It's a really good point. It's a really good point. I mean, they're in a really good position, and it's only the people I think may be concerned about the loans they have and the credit worthiness of those businesses. Have they deteriorated, from when the loans were first issued?
And so what,
right?
Like you were saying that if you were that the policymakers are probably in a state of quite high nervousness, and you didn't quite use that word, you used something else. I guess can you describe what you think the view is like from the US Treasury or from the Federal Reserve right now, what they're looking at and what they're thinking? I mean, if it's true, in a strange way, what you're saying is that there's enormous amounts of liquidity that has flown into the banks, but that doesn't help the broader economy because that is not flowing into a whole bunch of commercial credit that is about to
correct, which is coming due. It's coming due. So this is $3 trillion, which is not a small number, and that needs to be refinanced. And you need, of course, the elbow grease, you want to call that, of the small to medium banks. Have the relationships in the community. They're going to go and look at the assets, do evaluation, provide access to this loan, so the business can continue.
Well, then many businesses might not continue.
Well, I think what it comes down to, as you could put it back into economic terms, just the cost of capital, the cost of doing business. So it's just a burden that'll be borne by both large and small businesses.
But if they're not making credit available and they're not rolling loans, there's going to be just a whole slew of bankruptcies.
Right, because this debt, the cheap debt, they all got access to, as we just mentioned, during the pandemic. All that debt, it's not due today, but it will, in
the likelihood that it comes to you in a low interest rate environment, unfortunately, for those people who are going to have to roll the debt, is extraordinarily unlikely, unfortunately for them. Now, Bill Ackman is very public about saying that the Fed should go and guarantee every single regional bank deposit and more. I don't think they have the legal authority to do it. What do you think of that?
Well, again, that's above my pay grade, and I don't have the legal training, but I believe you're exactly right. I think the Treasury and the Treasurer like Janet Yellen, Jerome Powell, do not have that authority. So Congress would have to bring in some legislation.
And I suspect that they just don't want to go through another round of being made unpopular for saving the rich people, because they're from the view of the general voter, whenever you take an action like that, you're saving rich people, basically, and they hate that.
Well, I think right now, the most important thing, and like any financial system, is the trust in the Federal Reserve, that they know what they're doing, that they're monitoring the market, that the trust in the Treasury in a US dollar is based on that, just trust. And so the run on the bank that you mentioned can happen in countries, and often does happen in countries if you go around the world, And that is literally something that the central bankers of the world, for example, the Bank of England or the ECB or the US Treasury, they must avoid that at all cost, because they have their own loans and debts, right? People lend, so they must ensure that there's confidence. And so therefore, Jerome Powell will continue to act in a way to be seen as a steady hand.
Yeah, I mean, do you think he's rattled?
There's no doubt they are having late nights looking at, because of course they have overseen through their very extensive system through the various regions. They'll now be talking to the regional overseers. They'll be looking at what's happening, in each of the regions. They'll be looking at the small and medium banks. They'll also be talking to the counterparties globally, because they do not want to be out of step with the ECB, with the Bank of England, the Bank of Japan, and the other major G7 countries, but also the smaller countries, because they also will be getting rattled, right? Because inflation's hit them worse. And so now those small companies also may be at risk of default.
Countries.
So they'll be looking at all these things. So it's not an easy set of mandate.
I get the strong sense that both in terms of setting expectations and the pace of interest rate rises, it happened probably, faster than I guess they were trying to nip runaway inflation in the bud, and felt like, or believed that aggressive interest rate rises would nip runaway inflation, and instead they gave themselves the perception of a banking crisis. It's not actually a crisis of capital at the banks, it's a crisis of confidence.
Right, in some ways, yes. Well, number one, and you're absolutely right. I mean, basically, they want to be seen to be moving fast, so they weren't dithering. And that was basically to walk back, Jerome Powell's earlier comments, the transitory inflation comments, which were just wrong. Number one. Number two, I think they could have had rates rise at a slower pace, but I think they were playing catch up, and they needed to have done that much faster. And on the positive side, I will say, it's very clear that inflation, for example, in the US has peaked and is coming down. So that's positive.
So how long,
it's something when you raise rates that fast, things break.
Yeah, so that's a good thing. That would set expectations for lower interest rates 2 or 3 years out. While you were talking, I'm not finding it. It's so long since I've put up a yield curve chart on my Bloomberg monitor that I have open here. But I don't know, like, just to get a sense, can you just give a sense of, I don't know if you've looked at one recently, what's the current Fed funds rate? What's it at 1 year, 5 years, 10 years?
So right now, the 10-year, for example, just this morning was 3.3. This is shocking, right? The Fed is saying we're going to raise rates. And by the way, if inflation, the core inflation is running closer currently 5-6%, you need, if you follow, there's a number of principles like the Taylor principle that would say you should raise at least 1 to 2 points above the inflation rate if you're going to bring inflation down. So the long-term 10-year should be, at least the 2-year, should be closer to 7%. But the 10-year right now dropped, from 3.4% down to 3.3% this morning. So the market, the bond market, and let's face it, they're some of the smartest people in the world, they believe that the central reserve banks will be lowering rates in the future. So they're pricing it down to 3.3% at a 10-year rate.
And what's the 20-year? Do you know what the 20-year is at?
Oh, you're asking these good questions. No, I don't.
No, yeah, I should be able to just pull it up, and it's so long. I could do it right now, but I'm not going to do it. So just to go to Switzerland for a second.
Sure, I wish I could.
Yeah, people are kind of shocked in Switzerland over the sudden increase in concentration in the domestic bank market.
Yeah.
And actually, just tandem with that, there are these additional tier 1 bonds, AT1 bonds, that were written down to zero in this kind of shotgun sale and restructuring of Credit Suisse that has spooked that market because they suddenly realized that these can actually run at a loss.
Well, they realize they're not bonds.
I don't know what
They're
you call
investment.
them.
They're assets. They're just investments, but they weren't backed by the full faith of the Swiss government. They were investments.
No, and so yeah, but they were at risk money for sure. I think that I mean the Swiss governmental authorities certainly, I'm certain, were within their legal powers to do what they did. But when you have Credit Suisse shares traded at maybe a 1.50 franc, but the sale went through at a discount to that 1.50 franc. And if you're just doing a buy, Bank A is buying Bank B, they don't get the right to write down a whole tier of their bonds. And so in order to make the deal sweet enough for UBS, it seems to me that UBS said, well, we're only going to do it if we get a 17 billion discount. And the Swiss government used, so they're kind of like trying to get as much margin of safety as possible. But and I don't understand that market, but there are investors who are saying it was done under emergency powers. This is a violation of the principles of the rule of law. You acted in a capricious manner. And if a government authority could act in a capricious manner over these bonds, over what other bonds could you act in a capricious manner? EU authorities, other sovereign authorities were very quick to say that was a unique case. We'll never do to you what the Swiss just did to you.
They all say that. Right. No, it's a good point. And it is a unique case. Every crisis is unique in the source and the causes. But I can't talk about that particular merger in great detail because I've not been as close as I should to really comment. But if I reflect and go back, for example, to some similar mergers we saw in times past, for example, Jamie Dimon talked about when his bank, JPM Chase, was forced into a marriage with Bear Stearns.
Yeah.
And he says, looking back now, and this is when he was approached by the Federal Reserve to step into Silicon Valley Bank.
Right.
And he first come up with this. He said, because of Bear Stearns, because of that marriage, that cost us so much. Because then we as the banking system in America went from 10 big banks down to 5. And then we were held for all the problems that were caused. And there was immense regulatory overlay, like an order of magnitude of more regulations and regulators reviewing our conduct. Right. And just from Bear Stearns merger alone, it cost us far more than we gained. And that's why I'm not going close to helping any other bank. But then literally a few days later, all of a sudden he's marshalling some of the other leading banks to step in to assist with these small and regional banks. Because he realized ultimately he has a prominent role as the leading bank, one of the leading banks in the US, to step in.
And the way I explained that to one of our investors is that they said, well, couldn't UBS have just said no? And I kind of said, look, remember, UBS may itself have to turn to the federal discount window at any moment, or in this case, the Swiss National Bank's discount window. They got to play nice with the Swiss National Bank. The Swiss National Bank, I'm just going to pause and say goodbye to Dan, who's just walking out the door. Have a good, you're going to end up on this podcast, Dan. So Dan Voskill was doing something opposite me and he's now off later.
Perfect. Cheers, Dan.
The Swiss National Bank would have said to UBS, oh, you're not going to play nice with us on this. You're not going to do our shotgun marriage. We can come at you in 1,000 different ways and make your life a misery. And so they kind of just succumbed, which is effectively what JP Morgan did with Bear Stearns. And when no bank was willing to show up for Lehman Brothers a few months later, and they decided to, I don't think that any central banker or banker in general would want to see another failure like Lehman. But
Lehman, that was that, as you just mentioned, it was like the reverberations of the Lehman bankruptcy was heard around the world, and it froze the market. And it took, well, it's even now, over a decade to go through and resolve all the mess that created.
Of course, I happen to know one person for whom a trade, a buy or a sell, was caught up inside the bankruptcy, and it took, I don't know, 18 months for him to get his cash out or the securities out, one of the two. And you've probably worked on that bankruptcy.
I did work on that bankruptcy, and I remember trying to value the assets at the moment of default. It was like some things were easy, like cash and just bonds, but some of these derivatives, Lehman was one of the most creative, brightest bankers around, and they had some very complex derivatives that they were, and the counterparty to those trades ran from individual investors you mentioned, but also big banks, big funds, big hedge funds, PE funds. And these derivatives had to be valued at that moment and say what was the value, and therefore what is the recovery under the terms of the estate. It's quite a complex process.
Yeah, so nobody wants to see that. I think that what I'm sort of surprised by is that the terms of the merger that UBS must have negotiated, one was the write down of these additional tier securities, which gave them a cheaper purchase price by 17 billion. And then I had imagined that they would have been required by the Swiss Competition Authority to spin out or retain as a separate competitor Credit Suisse domestic operations, which is apparently a jewel in the crown. It's always been profitable. It's got all sorts of good things going for it. And somehow they managed to secure a waiver of Swiss. So people in the Swiss market are asking, what, we're now going to be left with just one kind of big bank, big Swiss bank, and a bunch of small ones. That just seems strange. That seems like too much concentration in the market.
Oh, but as you just were talking about, and we were reviewing over time, this has been a pattern when there has been a crisis. The regulators wisely do want to avoid events like Lehman's bankruptcy, which would have been the same thing with Credit Suisse, major bank, and it would have been far worse if they had been permitted. So they were correct, I believe. I mean, hindsight is not perfect, but I believe it was better to make sure that the bank didn't collapse into bankruptcy. However, you're right, there was a whole bunch of things now going forward. We think about not just the American banking system going from 10 big banks to 5, or when, for example, Arthur Andersen went bankrupt, if you remember, after Enron. And Arthur Andersen, that was one of the 8 auditors, and they've gone from 8 audit firms, now there's 4. So there's less choice. And when there's less choice or less competition, it's not good for consumers. It's a general blanket statement.
And I think that I have I think of POSCO in Korea. POSCO the story is that POSCO helped all sorts of industries in Korea develop because they offered a rock bottom price on steel to all local manufacturers. And if UBS seeks to make money out of the domestic Swiss market, Switzerland, rather than being a financial center, may find it very hard to compete because this large bank with assets which are 200% of Swiss gross national product is just going to be sucking money out of the Swiss market and making other places relatively more competitive. I think that there are a lot of Swiss policymakers that are walking around with a huge headache. And I guess in defense of those people who were called back over the weekend was that they perceived that they could not get to Monday morning with anything other than a merger with UBS, and they had to take whatever action they had to take. I mean, another option would have been to put the bank into conservatorship, or nationalization of the bank. And it's not clear. And then a nationalized bank could be divided into good bank, bad bank. The good parts spun out as quickly as possible, and the bad parts put into runoff. But somehow that was the only thing that I can imagine that they were thinking is that would have been too politicized. So the minute you nationalize it, you cannot run a rational resolution process.
Right.
So they just decided to put it onto UBS, and it's a fascinating new world. So there's I think that maybe one can say there isn't a crisis of capital at the banks. There's a crisis of confidence, which is in a way more difficult to cure, because all the Federal Reserve could do is provide more capital, but they can't create confidence in a bank. And I'm not sure if we already said it. The issue at Deutsche Bank is not capital, it's confidence in the bank.
There is, and that is, it raises the question. I understand, ghost of crisis past. Yes, they have been in the European banks one that have drawn the fair share of criticism and weakness of capital provisions, but you would think they seem to be in a very solid position at the moment, and yet there is this crisis leading to this massive run-up. And ultimately, when it comes to Switzerland, back to an earlier point you were just discussing, I'm wondering now, when you think about Switzerland, I always think it always had been considered as a safe haven. If you want to go risk off, investing in currency would flow to the Swiss franc because it was always seen as the safest bastion.
Yeah.
Right, so it would flow from the US, it would flow from England, it would go where? It would go not to Germany, not to France, it would go to Switzerland. It was seen literally as a rock. I mean in a positive manner. It was solid, your money was safe. And I'm wondering now if they're looking at that reputation, that trust,
Yeah.
and country risk, they were still solid, after losing one of the two biggest institutions in banking.
Yeah, and the apparently capricious nature of the decisions taken over that weekend. One part, obviously, I've been following Credit Suisse far closely. So just to fill you in and then to get your commentary. So a bank called Saudi National Bank had made an investment in, I believe they owned about 10%.
Just under 10.
Right, and then there are these famous comments made by, I guess, the chairman of Swiss National Bank, where he said that Swiss National Bank wasn't planning to put any new money into Credit Suisse. And that seemed to be one of the important nails in the coffin for Credit Suisse. And I think that he must regret his comments terribly because they were so ill-advised. I remember saying to myself, well before the crisis, oh, the Saudi National Bank is there, Saudi Arabia, plenty of money. If it's great that they want to buy into a European bank. How smart of them to do it. It'll get them many relationships. And yeah, they need to have deep pockets. A couple of weeks ago, somebody had asked me, he'd met me for the first time at an event called World Minds, and he says, oh, you're a value investor. Is Credit Suisse good value? And I said, look, it's trading at a discount to book. But, there's a huge balance sheet, and we don't know if there are more cockroaches in the cupboard. What if there's another green cell that somebody's been hiding that destroys book value? And that's okay because there's a franchise value, but I need to be prepared to come up with a lot more capital. So it wasn't something that I would ever have wanted to do. But if you're the Saudi National Bank and you're ready with 5 or 10 or $20 billion more to invest, or Swiss francs, then it's fine. But his comments implied that there's no more money coming from us. And it was a kind of a shock to me because the whole benefit of being Saudi National Bank and investing had been taken away. And,
right.
And now he's lost all his money, basically.
I can only imagine that he made these comments were thoughtful when he made them. But as you just said, as a significant shareholder, number one, I was very surprised he would state something publicly like that at all. But more importantly, as you just said, when you look at for example, the results of Saudi Aramco with record profits just declared last couple of weeks, the sovereign wealth fund of Saudi Arabia has stepped in during the pandemic and bought shares of BP and Shell. I mean, the kingdom is very well capitalized.
Yeah.
And if they wanted to inject 10 billion, 100 billion, they could have, and they chose not to. But then why did they make it public? Is curious.
Well,
why would they do that? Because then, as you said, that may have been one of the elements that unraveled when they found no more equity was coming, but their investment was put at risk.
They could have, what that chairman could have said is, we don't believe the Credit Suisse needs any more capital. But if it comes out that it does, we are certainly ready, along with other parties, to make sure that they have the capital they need to get through a period of stress.
Yeah, of course. I can't speak about what he could have said, but I did what I observed Warren Buffett did back during a previous crisis. And of course, you probably remember this, when he stepped in during the great financial crisis, and he put in, I think it was $5 billion into Goldman Sachs.
Yes.
And he was like, they've got my full faith that
Yes.
Goldman Sachs is a good institution. And by the way, when Warren Buffett speaks as a value investor,
Yeah.
the market listened. And what was stunning, in that one move, not only was it a genius investment by Warren, but the whole market just rebounded like, oh, because they've been thinking, there are institutions that are creating that have value.
Yes, and in the case of Bank of America, whom we also gave $5 billion to, he said, you don't need the money. He called, apparently it's a real phone call. He calls up Brian Moynihan and he says, look, you don't need this, but would you like me to invest $5 billion? And Brian Moynihan says, yes, that would be great. Thank you very much. Right. And Warren says, I'll take a bunch of warrants with that. Right. Yeah, as he did with Goldman Sachs. But so it's kind of a shame, because I'm sad that Credit Suisse is no longer.
Well, that's what Credit Suisse would have needed. Where was that Warren Buffett? And of course, you can imagine there's many wealthy individuals and funds. You know, you could think about the CEO of LMVH, right? Wealthiest man, I think.
He might not have had the liquidity. I think it would have been a sovereign wealth fund or similar. I mean, by reputation, he's worth quarter of a trillion. But you need the actual cash to shove in there, you know.
Excellent point. I think that in
Warren's case, you know, he might have done it for an American bank, but he wasn't about to do it for a Swiss bank. So, and we still don't know what. You know, I asked somebody at Deloitte, who was a partner auditing banks, and she said, you still don't know that there may be somebody in some office sitting on enormous losses that they're still not yet ready to reveal. You know, you can be, I mean, we might find out that UBS in 6 months' time uncovers another few billion, 10 billion of losses. Who knows? Right. So a few closing questions, Richard. So the one closing question is, you know, this crisis of confidence, how long do you think it lasts? Is this an ongoing crisis, or does this come to an end pretty quick? And I'll step in with my opinion. Well, that's the first question. The second question is, you know, what does work look like for you? What are you working on? What clients can you talk about? What future clients can you talk about? I'm kind of curious to see where your work is going. So that would be the second question. But to go back to the first question, because the banks are so well capitalized, I believe that this crisis of confidence can be turned around quite swiftly. But maybe you have different opinions. I'm curious to hear how long this crisis lasts.
Yeah, I'm firmly in your camp. I think that, in essence, both companies and individuals are well capitalized. In fact, that was, as we talked about, you know, today, that's one of the causes of the high inflation, the persistent high inflation. So I believe, with the consumers and business so strong, they will weather the storm. So right now, it's just a matter of the banks getting a solid footing, understanding their exposure, and then begin lending again. The Federal Reserve in this country, at least, has made access to capital, and they can do that. And so they just need to get back to business. And I think this crisis in confidence that is now rolling the European banks, I'm not too sure what steps those banks or the regulators in those countries will take to ensure the depositors that their money is safe, because that's what it comes down to.
Yeah,
they won't lose everything.
So, so all we can say about just going back to what's on your plate. All we can say is that you are working within. You worked in the past on Lehman Brothers. I forgot about that. You're inside FTX, and you're inside Silicon Valley Bank, but there's nothing you can say about it. Although anything
about any of those things right now, because of all these tremors we're talking about, it's placed a lot of small and medium companies with distress for exactly that reason. Just basically access to capital, getting. So I am working currently actually on a number of matters in restructuring in the courts. I'm also helping large companies with both antitrust and securities cases, just more regular business. But I've never seen such increase in activity by my clients in needing economic assistance.
Yeah. So what kind of activity does that? What kind of activity, when you say activity by your clients?
For example, valuation of their assets of their firms, like what does it mean given this new environment? Because when there's shifts in the global financial markets, when it comes to the bond rate, it impacts the cost of capital, cost of doing business. And when you have high inflation, that also ripples through as well to the margin. So companies are getting hit with this triple whammy of access to capital, squeezed margins, and of course they've got the debt coming due. And so that places them a point where they need assistance to work out where they are and what their options are.
And so then they come to you to help you to understand it.
Basically. Or my firm more broadly.
Yeah.
My firm's fairly large. It's like 9,000 people,
right?
All around the world, and we assist tons of companies. Not just in restructuring, but now in access to private equity, in performance improvement, in disputes and investigations. The list goes on in the various services that we assist them with. But when we see those times of high variability or volatility, that's when companies need help more, because they want to see, well, what can we do going forward?
So two very last questions, Richard. I know that as part of your time at Harvard Business School, you wrote some cases, and I'm just curious if you're interested to talk about maybe your more interesting or the cases that you enjoyed working on the most. And then very lastly, if somebody's listened to this and they want to get in touch with you, what's the right way to get in touch with you?
Sure. So when I was at Harvard Business School, I was looking at scalability. That is, how do you get a firm and increase it in size and value by several orders of magnitude, while also increasing financial performance? And so through that, I got access to many companies, and I got access to firms that were growing very fast, firms like Google or Yahoo or Amazon. These, as they call them, unicorns, they created billions of dollars of wealth in a very brief period of time, and all the firms that didn't, and what was the difference? And now when I look at what's happening as we speak with AI and ChatGPT and the other programs that are being built, and what a phenomenal invention that will just change the way we operate, the way businesses work, and no one knows the impact of value that those programs are going to have. And I'm sort of fascinated about the future and what it holds, particularly in the sciences, in manufacturing, but also when you're looking at researching drugs, say drug discovery. And now you've got these very sophisticated artificial intelligence programs and how they can help firms do discovery of these molecules. So I'm just fascinated about how the impact's kind of play out.
Do you think that Google's moat is widening or narrowing as a result of AI?
I think they're playing catch up. I think they were caught snoozing. I couldn't believe that Microsoft got the lead.
Both firms run by Indians, but but I overheard a conversation between two tech industry Indians who was claimed as to be common knowledge. I hope I'm not insulting anyone here, that the CEO of Google is a better businessman than the CEO. So Sundar Pichai is a better businessman than Satya Nadella, but who knows? So
that's just grandstanding. That's just grandstanding. But at the same time, I think they're both terrific businessmen.
Yeah.
And both terrific businesses. Now, in terms of your final question, you said how to contact me. Well, my name is Richard Bergen. I'm a managing director at Alvarez & Marsal. You can find my details on my firm's website. Shoot me an email. I'm happy to chat.
I shoot Richard emails and he responds to me, so maybe he'll also respond to you. And I should say that Richard was extraordinarily helpful to me during my own very special bankruptcy of Horsehead Holdings, and so I'm very appreciative of the work you did there, Richard. So thank you, Richard, for joining me. This was a sort of like very short notice. We're going to try and get this out as soon as possible. It might still be relevant by the time it gets published. And see you all again anon. Last words from you, Richard?
Well, I really enjoyed this conversation. And I know there's many things changing right now, and so I'm sure everything that I spoke about will be, as you mentioned, maybe not relevant tomorrow.
Outdated, but actually I'm going to give you one last, which I realize is a question, and maybe I should have asked earlier. So just to like a few, so many of the people listening to this are either private investors, owners of businesses. Maybe they've got a loan to roll. Maybe they got to take actions in the face of very changed interest rate environment. You know, what thoughts do you have? What actions, ideas for them? This is, by the way, Richard's completely unprepared for this, so I'm just throwing this at him, and he's got to like respond. But
I was thinking right now is exactly the time where businesses should assess their position and take action quickly. Right now, cash is king. Right now, there's little assurance that you'll get access to capital if you need it on short notice. So conserving capital is super important. And right now, there's also, conversely, amazing opportunities. We talked about, for example, Warren Buffett and his very prescient investments in Goldman Sachs and Bank of America. Investors had very high returns when invested correctly during the financial crisis. Many people lost their shirts because they were frozen or they made the wrong moves.
yeah,
But right now, prices and values are moving quickly. And as we've talked about, it's very hard to assess where is that value and where is the risk.
But I like that. You know, reassess everything, conserve your resources. Cash is king. Redeploy wisely.
Yeah, and know where you're going, because I think Warren Buffett first said he doesn't want to invest in anything he doesn't understand.
Yeah, and realities that may have been true a year ago may not be true today anymore.
Oh, it's changed immensely when the cost of capital has doubled or tripled.
Yeah,
Everyone's basis is different.
Richard, thank you so much. See you all anon.